The Wealth Building Blueprint, a beginner's guide to investing for financial freedom. Introduction. Investing can be a powerful way to grow your wealth over time. However, if you're new to investing, it can be difficult to know where to start. In this video, we'll cover the basics of investing, including the different types of investments available and how to get started. Part 1. Understanding the different types of investments. Before you start investing, it's important to understand the different types of investments available. The three main types of investments are stocks, bonds, and mutual funds. Stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a share of that company's ownership. Stocks can be a good long-term investment, as they have the potential to earn higher returns than other types of investments. Bonds. Bonds are a type of investment where you lend money to a company or government in exchange for interest payments. Bonds are generally considered to be lower risk than stocks, but they also have lower potential returns. Mutual funds. Mutual funds are a type of investment that allows you to invest in a variety of stocks and bonds with a single purchase. Mutual funds are a good option for beginner investors, as they offer diversification and professional management. Part 2. Setting investment goals. Before you start investing, it's important to set clear investment goals. This will help you determine your investment strategy and ensure that you're making investments that align with your long-term goals. Short-term goals. Short-term goals are those that you want to achieve within the next 1 to 3 years. Examples of short-term goals might include saving for a down payment on a house or paying off high-interest debt. Medium-term goals. Medium-term goals are those that you want to achieve within the next 3 to 5 years. Examples of medium-term goals might include saving for a child's college education or starting a small business. Long-term goals. Long-term goals are those that you want to achieve more than 5 years in the future. Examples of long-term goals might include saving for retirement or building a substantial investment portfolio. Part 3. Getting started with investing. Once you have a clear understanding of the different types of investments and have set your investment goals, it's time to start investing. Here are some steps to get started. Open a brokerage account. In order to buy and sell investments, you'll need to open a brokerage account. There are many online brokerages that offer low fees and easy-to-use platforms. Determine your asset allocation. Asset allocation refers to the mix of stocks, bonds, and other investments in your portfolio. Your asset allocation should be based on your investment goals and risk tolerance. Choose your investments. Once you've determined your asset allocation, it's time to choose your investments. This is where you'll decide which specific stocks, bonds, or mutual funds to invest in. Part 4. Monitoring and adjusting your investments. Investing isn't a set-it-and-forget-it activity. You'll need to regularly monitor your investments and make adjustments as necessary. Here are some tips for monitoring and adjusting your investments. Rebalance your portfolio. Over time, your asset allocation may drift away from your target due to market fluctuations. Rebalancing your portfolio involves buying and selling investments to bring your asset allocation back in line with your target. Review your investments regularly. It's important to review your investments regularly to ensure that they're still aligned with your investment goals and risk tolerance. Consider working with a financial advisor. If you're unsure about how to monitor and adjust your investments, consider working with a financial advisor who can help you develop an investment strategy and manage your portfolio. Conclusion. Investing can be a powerful way to grow your wealth over time, but it's important to understand the different types of investments. There are many different types of investment options to consider, and the best one for you will depend on your financial goals and risk tolerance. Some common types of investments include stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, and commodities. Stocks are shares of ownership in a company, and when you buy a stock, you become a part owner in that company. Stocks can be purchased individually or as part of a mutual fund or ETF. Bonds, on the other hand, are loans that you give to a company or government entity. In return for the loan, you receive regular interest payments and a promise to return your principal investment at the end of the bond's term. Mutual funds and ETFs are a way to invest in a diversified portfolio of stocks and bonds without having to purchase them individually. These investment options are managed by professionals who select the individual investments that make up the fund or ETF. Real estate and commodities are alternative investments that can be used to diversify a portfolio. When getting started with investing, it's important to consider your risk tolerance. Investing always involves risk, but some investments are riskier than others. Stocks, for example, tend to be riskier than bonds but can offer greater potential for returns. On the other hand, bonds are generally less risky than stocks but offer lower returns. Another key factor to consider is your investment time horizon. Investing is a long-term strategy, and the longer your time horizon, the more risk you can generally afford to take on. This is because you have more time to recover from any short-term losses. One common mistake that beginners make when investing is trying to time the market. This involves trying to buy investments when they are at their lowest point and sell them when they are at their highest point. The problem with this strategy is that it's virtually impossible to predict when the market will be at its highest or lowest point. Instead, a better strategy is to focus on your long-term investment goals and develop a diversified investment portfolio that aligns with those goals. It's also important to be patient when investing. Investment returns can be volatile in the short term, but over the long term, the stock market has historically provided solid returns. In fact, over the past 100 years, the stock market has returned an average of 10% per year. In order to get started with investing, there are a few key steps to take. First, it's important to educate yourself about the different types of investments available and the risks and rewards associated with each one. Next, determine your investment goals and risk tolerance, and develop a diversified investment portfolio that aligns with those goals. Finally, be patient and disciplined in your approach to investing, and avoid making rash decisions based on short-term market fluctuations. Overall, investing is a powerful tool for building wealth over the long term. By educating yourself about the different types of investments available and developing a disciplined approach to investing, you can set yourself on the path to achieving your financial goals. Thanks for watching.